This video is all about depreciation expense. And in it, we're going to do two main things. First, we're going to go over the basic idea of what depreciation is and isn't. And then second, we'll go through how to calculate depreciation expense using the straight line method and also the accelerated depreciation method known as the declining balance method. Let's start by getting into what exactly depreciation is and, just as important, what it isn't. The technical definition of depreciation is the systematic allocation of the cost of a long-lived asset over time. It's a bit of a mouthful, so let's unpack it. First off, why do we have to allocate the cost of an asset over time? Well, it's because of something called the matching principle. And if you remember, the matching principle in accounting says that we should match expenses with the revenues that they help produce. So if you had a long-lived asset, let's say, for example, a production facility, that's going to be useful to you in generating product that you're eventually going to sell and produce revenues for many years. So it wouldn't make sense under the matching principle to allocate all of the cost of that asset in 1 year. So in depreciation, even though we purchase the asset in 1 year, you're going to allocate the expenses over the useful life of the asset. And because of that, depreciation is not a cash expense. You have the cash outlay, in this case for that production line, in the period in which you purchase the asset. But even though you have the cash outlay in that period, you're not recognizing all of the expense associated with that asset. In subsequent years, then you're going to allocate that expense bit by bit. But in those subsequent years, even though you have the expense allocated and the expense is recognized, you don't have a cash outlay. This is important because as finance people, we care about cash flows. And if you're estimating cash flows and you're starting with a number, an accounting number, that has already had depreciation expense deducted, say operating profit or EBIT, in order to convert that back to cash, you'd have to add back the depreciation expense. Another thing to remember about depreciation expense is that it's not a measure of the decrease in value of the asset. It's pretty understandable to be confused because in normal terms, if you're talking about something and you say it's depreciated, you pretty much always follow that with in value. We say something's depreciated in value. But this is not general on-the-street conversation that we're having. We're talking in an accounting framework. And in an accounting framework, all depreciation is the allocation of an expense that occurred in a previous period. So where do we use depreciation? You're going to see it typically when you have a physical, a tangible, long-lived asset, like property, plant, and equipment. Now, you don't use depreciation for land. So you might use it for a building, you might use it for equipment within that building, but you don't use it for the land. Physical, tangible, long-lived assets. What about intangible assets? Well, for intangible assets, we have something similar to depreciation, but we call it amortization. And amortization is used if you have an intangible, long-lived asset that has a finite useful life. So you can identify what the useful life of that asset is. If it's got an indeterminate useful life or an infinite useful life, then you don't amortize that asset. What you would do is something called impairment. So annually or thereabouts, you test to see if the value of that asset has decreased, and if it did, you would impair the value of that asset. Okay, what are some of the methods that we're going to use in depreciation? Now, regardless of the method, you have to make a couple of estimates. Now, these are estimates that you make at the time that the asset is put in place. You have to make an estimate of the useful life of the asset. Now, for many assets, that estimated useful life you're going to get from an accounting standard. For example, if you've got a personal computer under IRS code, you would depreciate that over a 5-year useful life. So you're making an estimate of that at the time you put it into practice. Second, you have to make an estimate of the salvage value. Sometimes we call that the residual value, which is what you would be able to sell this for at the end of its useful life. And again, that's an estimate. Once you've got those estimates, you have a choice of several different depreciation methods. And typically what you try to do is match the depreciation method to the pattern of the using up of that asset. What are the methods? Well, the first and the easiest is the straight line depreciation method. We'll get into that in a few minutes. There's also the accelerated depreciation method. Sometimes it's called the diminishing balance or the declining balance method. And MACRS, which is Modified Accelerated Cost Recovery System, which is what you use for tax accounting, is an example of this. In straight line, the depreciation expense is allocated evenly over the useful life of the asset. Under an accelerated depreciation method, you have more depreciation in the early years of the asset's life and less later on. And third, you've got a method called units of production. And units of production, you allocate that depreciation based on how many units are produced in a period. For an example, let's say we'll get back to that production line, and that production line is expected over its useful life to produce 100,000 units. In a given year, if you produce 20,000 units, then you would depreciate 20% of the value of that asset and recognize that amount of depreciation expense in that period. Let's do a couple examples so we can drive this stuff home. We're going to start with a very simple one based on straight line depreciation. Let's assume that you've purchased a piece of equipment that cost $9,000 and it's got zero salvage value and its useful life is 3 years. What's the annual depreciation expense going to be? Well, it's just the cost minus the residual value, both of those in parentheses, all divided by the useful life. And that cost minus the residual value would be called the depreciable basis. How does this play out? In the first year, you've got $9,000 in cost, and then you're going to take out $3,000 in depreciation. So at the end of that first year, you're going to have a book value of $6,000. Second year, another $3,000. Now you've got a book value of $3,000. And after the third year, you've got zero book value. So under straight line depreciation, by the end of the asset's life, it's going to be depreciated down to its salvage value. Next, let's look at another method of depreciation, the declining balance depreciation method, sometimes called the decreasing balance depreciation method. Let's first go through the process. You start by determining the straight line rate. And all you do to do that is take 100% and divide that by the useful life. So if you've got a 10-year useful life, your straight line rate would be 10%. You've got a 20-year life, it would be 5%, and so on. Then you determine your acceleration factor. Are you using 1.5 times straight line? Are you using 2 times? Or so on. Third, to get your rate, your depreciation rate, you just take the straight line rate and you multiply it times the acceleration factor. So if you've got a 10-year asset and 1.5 times straight line, 10-year asset would be 10% depreciation. 1.5 times that, you'd then have 15% depreciation. Then to get your annual depreciation expense, you're going to take the net book value at the beginning of each year and multiply it by the depreciation rate that you got by multiplying straight line times the acceleration factor. Then every year you're going to repeat this. So every year your net book value is going to go down by the amount of the depreciation expense. And you're going to discontinue depreciation once net book value has gotten down to salvage value. So if a given year's depreciation would take you below the salvage value, you could only take the depreciation in that year that brings you down to the salvage value. Let's look at an example. You've got an asset with a cost of $11,000 and a $1,000 salvage value. It's got an estimated useful life of 5 years, and we're going to use an acceleration factor of 2. The question is, what's the annual depreciation expense each year? So we start with the net book value at the beginning of the year. And remember, we've got 5 years a 5-year useful life. That means that the straight line depreciation would be 20%. And with our acceleration factor of 2, that means we're going to be taking 40% depreciation on our net book value every year. So the first year, we're going to take 40% of the $11,000 net book value, and then the net book value at the end of the year would be $11,000 minus $4,400, or $6,600. The second year, our net book value isn't $11,000 like it was in the first year. Now the net book value is $6,600 because that was the net book value at the end of the first year. So at the beginning of the second year, net book value is $6,600. We multiply that times our 40% depreciation rate, and we get depreciation expense of $2,640. Now, if you look at it, our accumulated depreciation is going to be the $4,400 we took the first year, plus the $2,640 of the second year. So now, accumulated depreciation is $7,040. And our net book value at the end of the year is now $3,960. That's the $6,600 net book value at the beginning of the year minus the $2,640. Third year, we start with a net book value of $3,960. Depreciation's $1,584, and at the end of the year, net book value is $2,376. I'm going to just skip past the fourth year because the interesting part takes place in the fifth year. At the end of the fourth year, our net book value was $1,426. At the beginning of the fifth year, net book value is $1,426, and if we took 40% of that, we'd have roughly $5,610 in depreciation expense. But if we took $5,610 in depreciation expense, that would result in our net book value being below $1,000. That's the salvage value. At the beginning of the year, we had $1,426 in net book value, so all we can take is $426 in that year, because that would bring us down to the $10,000. All right, let's try another one. Here's the problem. You've got an asset that you purchased for 20 grand. It's got a 20-year useful life and a $5,000 estimated salvage value. You're going to depreciate it using 200% declining balance. So let's just look at what the depreciation is for the first 2 years and what's the net book value at the end of year 2. Pause the video and see if you can calculate the depreciation expense and the net book value. And then once you've done that, restart it and then check your work. I put the text of the problem up top so you could see it and you don't have to flip back and forth. But let's start with the first year. You've got a straight line rate of 100% divided by the 20-year useful life, so you get 5% a year. That would be the straight line rate, and we're using 200% acceleration factor. So our depreciation rate is going to be 10%. So in the first year, the depreciation expense is going to be $20,000, which is our book value at the beginning, times 10%. So it's going to be $2,000. And the net book value at the end of the first year is going to be $20,000 minus the $2,000, or $18,000. For year 2, our depreciation expense will start with the net book value of $18,000, multiply it by our 10% depreciation rate, and we get $1,800 in depreciation expense. And the net book value at the end of that would be $18,000, which is our beginning net book value at year 2. It's also the ending net book value at year 1, minus the $1,800, $16,200. All right, let's close out with a quick summary of what we've done here. Depreciation is not a cash expense. What it is, it's just the allocation of the cost of an asset over its useful life. If we've got an intangible asset with a finite life, we're going to use amortization instead of depreciation. Depreciation requires some estimates. What are the estimates you have to make? You have to make an estimate of the useful life and you have to make an estimate of the salvage value. Those are estimates going forward, and if you want to find more information about those estimates, you look in the footnotes. And then finally, we talked about, in general, the three methods of depreciation: straight line, accelerated, and units of production, and we worked through a couple of examples.